Alright, today we're going to be looking at CD Projekt SA. As always, quick company description. It's a Polish-based entertainment company operating two segments via the CD Projekt Red video game development studio and then the GOG.com digital distribution platform, which just basically sells third-party video games. Some of the notable games, I guess, that CD Projekt make that you probably heard of, it will be the Witcher series, so obviously Witcher 1, 2 and 3. And then recently they produced the Cyberpunk 2077 game, which had a bit of controversy, which we'll get onto. The revenue breakdown then, so obviously the CD Projekt Red is the primary revenue driver with around $200 million in revenue, and then the GOG.com platform produced around $40 million in revenue. Both declined. CD Projekt Red declining is to be expected. There was no major releases, so obviously that business is very heavily dependent on a new video game being released and coming out, whereas the GOG.com platform I think is an overall indication of the video game sector in general, which in the last few years has been declining, to be honest, with the lack of good releases and just kind of you've seen a small sector decline. In terms of the main cost drivers then, so obviously when a game is released, we'll expect to see high marketing and launch expenses, which again we've not really seen the last couple of years. However, we will see high R&D costs every year, given the fact that these are massive, AAA games. They require massive budgets, high number of staff, and things like that. So we do expect to see high R&D costs every year. And then you do obviously then have the ongoing maintenance and support for the legacy titles, which to be honest is pretty trivial expenses. In terms of the sector and positioning then for CD Projekt, they obviously operate in the global video game development industry, where they have a strong reputation for making story-driven RPGs, again via their Witcher and Cyberpunk games. And they're kind of regarded, I guess, as a top-tier mid-cap publisher. So they're not as big as your EAs, who obviously produce all the sports titles, and then I think they have a few Star Wars licenses, and then obviously your Take-Twos, who again do sports and also the GTA 6 or the GTA video games. And a kind of news story surrounding the company as of recent in terms of PR is they had quite a rocky launch with Cyberpunk, where it came out really buggy and just not in a great state, but then kind of like, I believe there's another video game called No Man's Sky, which you can look into, but they kind of released loads of free patches and really worked on the game post-launch to kind of redeem themselves and kind of recover from that PR nightmare, to be honest. In terms of future outlook and growth opportunities then, I say there's 4 primary games in the works as far as I know of. The first being The Witcher 4, which has already been announced and we definitely know is in full production. There's also Cyberpunk Orion, which is a rumoured sequel and currently in early development for Cyberpunk 2077. Can never say that properly. And then you have Project Hadar, which I've heard about, which is a new original IP. So it's going to be a completely new original IP. So at the moment, obviously, if you didn't know, CD Projekt have kind of been known for taking a lot of Polish IP. So obviously, the Witcher books, the Witcher series is based on a book. And I believe, again, Cyberpunk is based on a book and already existing IP. However, there's rumours that with Project Hadar, they're going to finally release and kind of come up with their own original IP, which will be interesting. And then there's also the rumoured Witcher remake and Project Sirius to expand the franchise universe. In terms of like more technical side of things then, they're also rumoured to be moving to the Unreal Engine 5 to improve development efficiency, which again should help costs and gross margins. And then they're targeting cumulative net profit between 2025 and 28 of $1 billion, which is I think is what's driving the stock price at the moment. Quick overview then of the financial statements. As always, I'll keep it quite abridged and focus on the key items. As you can see, revenues pretty much since 2021 and post-release of Cyberpunk has flatlined with no major releases and pretty much is expected to do so up until 2026. And then obviously at the moment we're expecting Witcher 4 to be released in fiscal year 2027, which is why you then see the massive jump up and increase. And to be fair, I think this is actually quite underreported. Given how big the Witcher series is, I wouldn't be surprised if this, to be honest, goes near the 1 billion mark. So yeah, but at the moment it's kind of been under, I guess, forecasted by analysts and coming in around 800 million. Another thing to draw your attention to then is just the incredible net income relative to revenue, basically the net income margin. So in 2024 you can kind of see here is nearly 50%, which is just, not really seen of much. You can kind of see 50% gross margins, but to see 50% net profit margins is really impressive, to be honest. Coming on to the balance sheet then. Again, really positive picture here. So they have basically minimal or no debt, and then their current liabilities and total liabilities positioning versus and relative to their assets is just very minimal. So very very strong balance sheet. And then cash flow again, so they obviously produce positive levered free cash flow year over year, and as expected with most businesses, investing and financing is negative, but then strong operations, positive cash flow. As always, I'd like to do a quick sector analysis and sector comparison. This one is quite extensive because I look at the video game sector quite in depth. So I've kind of like copy and pasted this from my sector overview worksheet that I have that you might see in my live streams. But focusing then on CD Projekt, you can kind of see the aforementioned net profit margin I mentioned, easily one of the best in the whole industry. The only company that's kind of comparable or has a similar is Krafton, who I believe produced the PUBG series. But aside from them, like no one else really. Maybe Koei as well, which again is another Japanese. It is a Japanese, sorry. I think Krafton is actually South Korean. But unfortunately, other than the net profit margin, then pretty much all red across the board from that. Again, it kind of makes sense. So the company is valued at a very, very high premium. I'm assuming due to their strong profit margins and then the fantastic IP it has, like the Witcher and Cyberpunk series. It's very focused. It doesn't have a lot of bloat, unlike a lot of other companies. So, for instance, Ubisoft has a lot of bloat with a lot of kind of dead IP. EA as well, where they're such behemoths. They also have a lot of loss makers. Whereas with CD Projekt, all their IP they own is pretty much high premium, top of the line IP that are highly profitable. They're also kind of like the darling stock of Poland, which again kind of exacerbates their valuation multiples. And then, as I kind of mentioned before, and as you'd expect, given how small they are in terms of releases and the lack of releases, year over year, you would expect to see revenue and earnings growth to decline until a release comes out, which then in conjunction with the high multiples, that just makes them, from a quant perspective, look really bad. Which I think CD Projekt Red is actually a really good example for why you should always look further into the numbers and kind of look at the qualitative aspects. Because if you just looked at it from a quant overview perspective, like now, you see this company and probably think it's a short, just again purely from these four figures here. But then when you actually look into the qualitative side of the business and kind of see just how efficiently it's being run, the IP it owns, and the pipeline coming through, it kind of makes a bit more sense. I still think it's overvalued, which we'll get onto in the fair value and price target analysis, but it's not as like dire or extremely overvalued as you would expect from this quick overview here. So as always, I've done a SWOT analysis looking at the strengths, weaknesses, opportunities and threats. I won't go too much into that, kind of let you either pause it or you can go grab the file for yourself in the description down below. We also have then the bull case and then the bear case. So again, pretty obvious stuff, but for reasons why you'd be a bull for CD Projekt, it would be obviously the blockbuster pipeline, multi-year upside. So we're expecting Witcher 4, Witcher Remake and Cyberpunk coming through. And then a kind of a similar in line with that, we have the valuable IP, but then you have like a transmedia momentum or opportunities, which I kind of touch upon in this section here. But essentially with their strong IP, we're also seeing them move into now like Netflix series. And so we can expect to see potentially more of that, which then they can benefit from as well. Margin recovery, like I said, the margin's really strong, and then they have some undervalued IP. Just some quick points to flag then about the bear case, or some risk points to be aware of. Again, the excessive valuation, which we'll come on to. 94 P ratio, 25x sales multiple. Very, very excessive in my opinion. Execution risk. So we've already seen this now with Cyberpunk 2077. Sorry. When the game initially came out, it had multiple delays. It was then broken on release with a lot of bugs, and the company took a massive PR hit and hit to their credibility when that game was released, and I think it will even impact Witcher 4 slightly. Again, they have kind of recovered it, but that risk is always there. If Witcher 4 comes out and has a similar, release where it's quite buggy and not as polished as you'd expect, then I think, CD Projekt could potentially go down the Bethesda route, where I think the industry kind of loses faith in them, and they could then potentially be a quick takeover target, kind of very similar in the vein to what happened to Bethesda, where they had multiple back-to-back buggy releases. And then some comments here just on the industry shift away from the classic CD Projekt Red model. So obviously, as I said, they kind of focus on story-driven games. So it's like a one-time release, and then you just buy the game and that's it. And then they maybe upsell you some DLC later on down the line. Whereas in the industry now, we're seeing a lot of movement towards live services and subscription models with like I guess like GTA Online is a good example, where it's like a live service game. It's constantly being updated, they're constantly selling you stuff, microtransactions, and it kind of allows for constant free cash flow to come in. Think of Roblox as well, like a good example. Okay, then quickly summarising then the fair value price target. As always, I value stocks on their earnings and sales, so top line and bottom line, assigning a multiple to both. We break the multiples down then via market. So the market multiples are essentially just what the prior year, final full year, fiscal year had, what valuation multiple that year had. So for prior year, we can see then the company had a 13 PE ratio and a sales multiple of around 6. And then a reasonable P ratio then, I believe, going forward is 20. The reason for that then is, again, the massive jump up, accounting for the massive jump up in 2027. So with the release of Witcher 4, so I think factoring that in, the really good pipeline, I think a 20 forward PE ratio is fair. And then a sales multiple of around 5. This is coming in from the sector averages. So again, EA has 5, Take-Two has 5. These are the more premium these are the more premium publishers. So I've kind of just given it in line with that. Konami has a 6, and then Capcom have 10. But one thing to, I guess, recognize with Capcom and Konami is they don't just do video games. They are also quite diversified, especially Konami. But yeah, as I've kind of mentioned already, you kind of read into here. But this is basically summarising everything I've talked about and then justifying the 20 and the 5 forward sales multiple and PE ratios. That then factoring also, the AI price target models. So again, there's various models done by AI. We always like to just have a quick overview and analysis on that. So factoring all those 5 in, then we get an average price target for FY25 of around $12 a share, which kind of represents a 20% downside, unfortunately. So at the moment, the share price as of the 20th of May was trading at $15 a share. Bit of downside, to be fair, but overall, I think if I was to assign, a buy, sell, or hold target allocation to the stock, I'd probably give it a hold. I wouldn't sell your stock if you already own it, but I also then wouldn't buy any if you don't own it. I think it's a pretty standard. I think it's a relatively fairly valued company at a slight premium, but nothing more than that. But again, you're paying slight premium for a fantastically run business with strong IP. So I think I'll leave it there. Again, as always, if you have any questions, just leave them down below in the comments. Otherwise, until next time.